Welcome to Investors Insights, episode number 168. Today we will be discussing the U.S. markets in relation to Brexit. And so we're going to jump right in here.
You're listening to Investors Insights with Greg Powell and the Portfolio Strategy team from Five Plan Partners.
Good morning, gentlemen.
Morning.
Great meeting this morning. Let me say this right off the bat. Throughout 2016, from the very beginning, I have been asked and you have been asked, why are you staying so conservative? Why are you keeping so much towards cash and bonds? Friday was the answer. Brexit hit hard unexpectedly, and portfolios here at Five Plan Partners, we were able to stay on top of it. And let me add this, there's no guarantees, but we are constantly looking to see where the markets and the economy and the politics and the economics will take us, and so that we make the right moves. Right. So, Bobby, recap for us right quick in terms of Friday and the Brexit that no one expected.
Yeah, so like you said, no one expected it, and that was the problem. The markets did not have it priced in, and our markets do not like surprises, and surprise it was. I mean, it was a big surprise. And actually, the world equity markets lost $2 trillion on Friday. That's the worst day in history for global markets. And so now the concern is the contagion.
Right.
Okay, so, the UK left, the Britons left, and who else is going to leave? Denmark, so-and-so.
Right.
And so, all this will play out over the next couple of months. And it's funny, we saw some interviews over the weekend, and some of the people who voted to exit were now saying, oh, gosh, what have we done?
Right.
And so it's not a done deal yet. Parliament still has to approve it.
Right.
And so we'll be watching that carefully. But it was a down day.
The news media really hasn't conveyed the fact this is just like a referendum that Parliament has to approve it.
Right. This is just really the beginning of what will be at quickest really a 2-year process.
And well, if the EU allows it.
Right.
If the European
there's going to be
Union allows it.
A whole lot. And then again, I want to say we didn't really predict the Brexit. The reason we're conservative wasn't just for the Brexit. It's really
that's true.
The Brexit is just a symptom of the overall illness that we're concerned about, which is really just global frustration. The rest of the world, including U.S., you see it, U.S. populism, nationalism. You see candidates like Bernie Sanders, Donald Trump. The unconventional is popular around the world because I think there's a whole lot of frustration. And Brexit is just one example of this. The populace, the average person on the street saying, you know what, I don't care what the central bank says. I don't like what is happening right now.
Right.
And so the Brexit's one symptom. We could see many more down the road. That's kind of why, even though the Brexit is now kind of in the rearview mirror theoretically, still want to be conservative because this is just the beginning of what is a frustrating process of the populace kind of revolting and which could create and usually does very good opportunities down the road.
Right. Well, that brings up the point though. We've already had people calling saying, okay, do we jump in? Do we buy? Keep in mind, we've said this throughout the whole year. We like the philosophy of buy low, sell high, provided you have money to buy low. And that's where we are at this particular point in navigating through this, is that it may not be time just to jump in as of yet.
Right. We saw the markets trade heavily back on Friday. It seems like, wow, that must be it. But the markets are only at points they were all the way back in mid-May. So we're really not giving up much as of yet. Yeah. This is going to be a very, very long process, and typically these kind of things create great buying opportunities. When you have babies that are thrown with the bathwater, you find companies that have nothing to do with Europe that get sold off. You can really find some good values.
Absolutely, yeah. And so, and also we have to keep in mind, and our viewership does too, you've got hedge funds that were taking positions that Britain would remain. And so now that they've been blindsided, they may have margin calls that they've got to sell things, which they may have positions in the U.S. market that they've got to sell those, which knocks our market down. So keep that in mind. There's an unraveling process that has to take place here. Right. Also, from the standpoint of impact to our markets and our economy, actually, you brought up a point in terms of just, the value of the dollar has gone up. It's a lot stronger. That's good for the person going over to London, on a trip this week. But the reality is, in terms of U.S. products, talk just briefly about that.
It's a harder sell. It's been a hard sell all year, to Greg's point, because of the strength of the dollar. But now, if you look at sort of a consensus forecast for the rest of the year that economists have, what's it going to do to our GDP? The consensus seems to be about 0.25% impact. And a lot of that is selling to Europe. It was already hard enough, but now you got the purchasers in Europe more uncertain on the ground over there. So it's now more expensive still, and it's more uncertain.
Right.
So that has a tendency to hit products in the United States that are heavy value add.
So our U.S. companies here or positions in the stock market could very well be impacted earning-wise because
Absolutely.
they're just not selling as much over in Europe.
That's
And Trey,
correct.
you brought up another point about currency competition here.
I mean, we've had a, I don't want to use the word currency war, but we've had a competitive currency market where central banks are trying to flood their markets with liquidity to push their currencies down. Because you have a weaker currency, it's easier for you to export. The U.S. is the only country that seems to be trying to do the opposite. We've had Japan trying to weaken their currency, the European Union trying to weaken their currency so that everything's cheaper to the U.S. consumer, which is the largest buyer in the world. And this just puts that on top speed, really, because we saw the British pound shoot down 10, 15%. Now if you want to buy a Range Rover or a Rolls Royce, I'm not sure how many purchases of those there are, but that's now 15% cheaper than it was a week ago. And Japan does not like that. They want to sell their Lexuses. And so now they're going to possibly try and compete to reduce their currency. And so you have these central banks trying to weaken, and you kind of have this currency war going on where people are constantly, central banks are trying to fight what the market's doing.
Yeah.
And it's going to get interesting. That's the kind of thing that takes slow rollout over time as things try and fight the current situation.
Absolutely. So on that note, we will leave you as we go into the week of the 4th of July coming up and our Independence Day here in this country with the understanding that we're on top of it, that we're keeping our conservative position, and we're doing so as we move forward to help our clients achieve their financial freedom and their goals and dreams. Because regardless of what's going on in the world, we need to be striving to create our own economy so that we can live the way we want to, the way you want to, and be able to help each other. So on that note, we thank you.